The Fed preferred gauge of core PCE price index for the month of September came in lower than expected. The University of Michigan preliminary consumer sentiment rose slightly modestly for the month of December. All in all, the Fed rate cut bets remains at a firm odds of more than 87%, as indicated by the latest reading from the CME Fed Watch 2, indicating firming up bets for the up and coming 10th of December FOMC meeting, where market participants has a pricing of a high odds of a 25 basis point cut. The US dollars remain weak on this firming backs of a Fed rate cut this Wednesday, where the US dollar remains below its 50-day moving average for the third consecutive session, and also the 4 major US stock indices rose for the second consecutive week. Good morning to all, and welcome back to your daily dose of market insights. I'm Kelvin here, and welcome to a brand new trading week. Today will be Monday, the 8th of December 2025. So as usual, before we jump straight into our gist of the daily dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. All right, so here we go. So before we jump straight into today's full suite of the daily dose of market insights, which cover all the intraday technical analysis, outlook for the major cross asset classes that we cover on a frequent basis, let's have a recap on the key data that has been released on last Friday, which is the core PCE price data and the University of Michigan of Consumer Sentiment for preliminary reading for the month of November. So let's very quickly take you through the calendar over here. So as you could see on my screen, if you look at the core PCE price index over here, so core PCE price index is actually the favored gauge of for among the FOMC members to monitor the general inflation trend in the United States. So the core PCE price index does strip out the volatile item, which is food and energy, on a month-on-month basis for the month of September. So why September? Because this is a delayed data due to the government shutdown that has only just concluded recently. It came in within expectation, 0.2% month-on-month, and also at the same pace of 0.2% month-on-month for the month of August. So market has penciled in 0.2%. But what's interesting over here is we stretch it out from on a year-on-year basis that's removed those seasonality factors. The core PCE price index year-on-year actually dipped down below expectation. So it came in at 2.8% year-on-year. Market is expecting 2.9% year-on-year, and also below the previous August print of 2.9%. So you look at the trend over here. So this is the first month in September. Finally, it has started to soften down. All right. So previously from May, June, July, August, it continues to rise up generally. So in the month of September, it finally dipped down after 4 months of consecutive gentle increment. So that actually also cemented the rising rate odds that the Fed potentially could cut on the 10th of December FOMC meeting, which is this Wednesday, early Singapore time, 3 a.m. So if you look at the CME Fed Watch 2 over here, so as we are speaking right now at 11:04 a.m. Singapore time, based on the latest data from the CME Fed Watch 2, is almost as high as 90%. So 88.4%, the market participants or the Fed Funds futures traders in the Fed Funds futures market has penciled in a high chance that the Fed will do a 25 basis point cut. So that is more likely has been almost 100% priced in the market. So what market is now looking forward will be the forward guidance by the US Federal Reserve officials, especially on the last meeting of this year, which also comes with the dot plot. So what is the dot plot? The dot plot is actually an average or and as well as a median forecast of key US economic data that the FOMC officials has a view going forward. So it will cover, most importantly, the inflationary trend, the GDP growth, and as well as what are the absolute level the Fed funds rate will be by the end of 2026, 2027, and in the long run. So that I will cover much in greater detail on Wednesday as we approach the FOMC date. So if you look at the aggregated tab over here, so the aggregated tab, what's interesting over here is that at the start of last week, it was penciled in 3 minimum of a 3 interest rate cut for 2026. So that has kind of toned down to only 1 interest rate cut before the release of the core PCE price index and the University of Michigan preliminary sentiment data for the month of December. So after the release of these two data, market participants in the Fed funds futures market still continues to pencil in minimum of 2 interest rate cuts. So that was down by 1 interest rate cut from the start of last week. So how do I read this table very quickly for those who are new? So if you look at, you've got to look down the calendar. So these are the meeting date. If you go all the way down, those are dates going forward, stretching as far back as 27th of October 2027. So if you look at, this is the 88% odds which I shared with you guys earlier on the 10th of December meeting. That means market participants expect the Fed to cut by another 25 basis points to bring the Fed funds rate down to 3.5% to 3.75%. So this horizontal line here is the various Fed funds rate, all right, over here. So if you go to your left over here, this shows that the rates gets lesser. That means it implies a 25 basis point cut going forward. So if you look down the probability, that means market participants expecting a high chance of 72% that the Fed will do the next move only in April next year, on the 29th of April 2026 FOMC meeting, to bring it down by another 25 basis point to 3.25% to 3.5%. Then thereafter, we have a high odds of around 83% and as well as 99% that the Fed will do another cut in 2026, either on the 19th of September meeting 2026 or the 28th of October 2026 meeting. And thereafter, the Fed will maintain it, because if you look at the last day of the meeting, last year of the meeting on 2026 will be on the 9th of December 2026. 71% chance market participants expecting the Fed to be at 3% to 3.25%. So if you look at the almost certainty of a 25 basis point cut on this Wednesday, that means that by 2026, it will be at 3% to 3.25% by the end of the year, which is on the last day, the last meeting of 2026, 9th of December 2026. So only minimum 2 interest rate cuts has been penciled in so far. So this is very important. So in order for the dollar to weaken further, the Fed rate cuts bets as being priced in by the Fed funds futures traders got to increase in 2026, all right, in order to maintain that downside momentum for the US dollar that has been seen in the last 2 weeks over here, which I share with you guys on the technical outlook on the US dollar index. So primary focus, the pivotal moment will be coming on this Wednesday. So Singapore time will be at 3 a.m. to 3:30 a.m. So we talk more about that as we approach the FOMC meeting on Wednesday daily dose, okay, which is at 11 a.m. Singapore time, right? So with that, so one of the reasons why the rate cuts bets has only be 2 so far in 2026 is because also driven by the consumer sentiment. So consumer sentiment for Michigan. So we know that US, there are actually 2 major consumer sentiment data provider. One is University of Michigan, and the other is the Conference Board. So Conference Board was weaker, all right, but University of Michigan shows a slight improvement for the month of December. So this is a preliminary data, a flash data. So University of Michigan will have 2 data. One is a preliminary one. Then after that, 2 weeks later, they will show the finalized December figure. So based on the preliminary data, it actually rose slightly by 2.3 basis points. So previously it was 51. So 51 is the second. This was printed in November. So November figure 51 is the second lowest level on record. All right, as compared by the University of Michigan. The lowest level was 50. That was during the pandemic period. So it rose up to 53.3. Market is expecting 52. So that actually explained to us why there is actually a continuation of the reduced of odds for only 2 interest rate cut in 2026 due to a more upbeat University of Michigan sentiment preliminary data for December. But all in all, what we could see over here is that the US stock market continues to bask in a bullish limelight. So later I'll share with you guys that the Dow Jones and as well as the S&P 500 is not far from the current all-time high that was printed earlier in October, before that AI bubble fill induced sell-off that has taken shape. So the only one that is the only one that closed in the red or on the intraday loss will be the Russell 2000, down negative 0.38%. So the rest of them actually closed higher. So the Dow Jones Industrial Average is up 0.22%, the Nasdaq and the S&P 500 up 0.4% and 0.2% respectively. Now, very quickly, take a look at the US dollar index. So this is what I mean. So you know that the US dollar index has been a bearish movement within a complex medium-term sideways range configuration, or I'll say multi-month sideways range configuration since the low of 1st of July. Bearish reaction at the upper limit of this medium-term pivotal range support level, which is 100.54, inch down lower, and ever since the 26th of November, it traded below the 20-day and the 50-day moving average. And on last Wednesday, 3rd of December, it managed to break below the 50-day moving average, which was our intermediate resistance support. Intermediate support turns intermediate resistance at 99.25. And for the next 3 consecutive sessions, including Tuesday, Friday, and as well as today's Asia session, it can't break above the 99.25 and shape a bearish reaction of it at the 50-day moving average candlestick as well. And if you look at the daily RSI, so the daily RSI has a bearish breakdown, no signs of any signs of a bullish reversal, and potentially it has still some more room to hit the oversold level. All right, so what it means that over here, the US dollar index in line with this up and coming key risk event on this Wednesday, Singapore time will be 3 a.m., which is the FOMC meeting outcome, followed by Fed Chair speech or press conference at 3:30 a.m. Singapore time Thursday. There could be a big risk that it could actually break below 98.67 based on the current bearish technical elements, like I shared with you on the daily chart of the US dollar index, to inch down lower towards the lower part of this complex sideways range configuration, with the next support coming in at 98.03 if 98.66 cannot survive. All right, so overall, the US dollar index in the very near term for this week still remains on a kind of a bearish bias, but within a multi-month medium-term sideways range configuration since the low of 1st of July over here. All right, so that sums up the first segment of the daily dose. We're going to share with you guys because it's more pertaining to the 2 key data, the US key data that was released on Friday. So let us now proceed to the intraday technical outlook on all the broad-based cross asset classes that we cover on a frequent basis. So before that, let me expand my screen, all right, so that you guys have a better visualization on the chart. So let's start with the euro dollar first. All right, so the euro dollar, within our expectation on last Friday, we still remain that bullish bias despite that it can't break above the intermediate resistance since last Thursday at 116.75. But what's interesting over here is that it managed to stage a minor bounce right exactly above the 116.15 adjusted short-term pivotal support that we have on Friday. We saw confluence with the 50-day moving average, and very clearly right now, the euro dollar is now evolving or oscillating within a minor ascending channel since the low of 21st of November. And what's interesting is that after that bounce that has taken shape on last Friday over here, after the release of the 2 key US economic data, which is the core PCE price index for September and the University of Michigan consumer sentiment preliminary figure for December, the hourly RSI has managed to shape a bullish breakout above a parallel descending trend line. And this parallel descending trend line previously kept the raw price action on the euro dollar since last 4th of December over here. So with this bullish breakout that is being seen on the hourly RSI, it kind of gives us a pre-indication that the momentum still remains bullish on the euro dollar on the shorter term. That means potentially there could be an increasing chance that the 116.75 may be taken out on the upside. So with that, no change given the current positive technical configuration that I shared with you guys a while ago, still using 116.15 as my short-term pivotal support level, given that the raw price action hasn't broken above 116.75. Above 116.75 potentially take us up to the next intermediate resistance level at 117.20 in the first step, which is a 1.236 Fibo extension from the first minor double bottom on the low of 5th of November, and 117.20 also confluence with the minor swing high of 6th of October and as well as 17th of October over here. Only a bearish breakdown and an hourly close below 116.15 will negate today's bullish bias to see a deeper pullback towards 115.90, which confluence with the rising 20-day moving average over here in pink. A breakdown below 115.90 will see a deeper retracement back towards 115.50, 115.40, which is also a key Fibo retracement level taken from the low of this second minor double bottom of 21st of November all the way up to the minor swing high of 4th of December. That confluence with the golden ratio of 61.8%. Right. very quickly will be the sterling dollar over here. So the sterling dollar also continues to manage to find support around the 200-day moving average and can't break above our first intermediate resistance at 133.70, which we highlighted on Friday as well. So given that it can't, so right now the first intermediate support level to watch will be at the 200-day moving average, and which is also last Friday swing low area that confluence with the swing low area on last Friday Asia session as well at this 133.20 level. But what's interesting is that the hourly RSI managed to bounce off from a ascending trend line support level over here. Let me put it in green. All right, and also managed to inch up above the 50 level, okay, as we are speaking right now, indicating that short-term bullish momentum remains intact for the sterling dollar. So with that, given that 133.70 has not been taken out on the upside, we will still be using the same pivotal support level at this 132.70, which confluence with the 50-day moving average as well, and as well as the lower limit of this ongoing minor ascending channel from the low of 21st of November that the sterling dollar has started to oscillate to be in. So as long as 132.70 short-term pivotal support is not broken, we'll still maintain that bullish bias on the sterling dollar. Only a bullish breakout and an hourly close during the European session above 133.70, then I will tighten my pivotal support to 133.20 with the next intermediate resistance coming in at 134.15, followed by 134.50 in the first step, which confluence with the upper limit of this minor ascending channel, and as well as the 2 times pivot extension from the low of 5th of November, first minor double bottom low, and the minor swing high area of 17th of October. Only a bearish breakdown below 132.70 will negate the bullish bias. Only a bearish breakdown below 132.70 will negate the bullish bias to see a deeper corrective pullback to retrace or a retest back to the 20-day moving average at 131.80/131.40, which is also the minor swing low area of 2nd of December and 3rd of December. So that's for the sterling dollar. Up next will be the Aussie dollar. So the Aussie dollar didn't actually do that pullback that intended. And what we could see now, the Aussie dollar managed to stage a hourly bullish breakout above the major resistance of 66.30. All right, over here. So let me put it in green. Oops, sorry. This level here, let me put it in green, and this line here, let me put it in dotted, no longer a red line, now turns into a brown line over here. So this 66.30, pardon me, a bit of time to sting. 66.30 has been clearly taken out on Friday with a daily close above it, and this 66.30 is a major resistance level. Why? Because it's a former long-term circular descending trend line that has been in place since the 25th of February 2021 high. So that was close to about 4.5 years ago over here. All right, so this is a former long-term descending trend line or a circular descending trend. So indicating that potentially with the bullish breakout of this 66.30 and the daily close above it, that means what we could see right now, the Aussie dollar could right now kind of previously it was a kind of a complex medium-term expanding range configuration since the low of April, got rejected at this long-term descending trend line in dotted gray from the high of 25th of February 2021 high that was 4.5 years ago. Did that corrective pullback managed to find support at the lower limit of the expanding range configuration from the April 2025 low, and also the key 200-day moving average, and with a daily bullish close and a daily bullish breakout above 66.30, this actually cemented potentially the start of a new medium-term to major uptrend phase for the Aussie dollar. So that also potentially represents that kind of a risk-on proxy for global stock indices as well on the average. All right, so with this positive technical element on the daily time frame chart, we will still definitely maintain a bullish bias right now on the Aussie dollar, but with a much more higher adjusted short-term pivotal support level. So 66.30, 66.20 will be the first intermediate level to watch for the pullback support level. So lower limit over here will be last Friday Asia session low, 66.05. So using a tightened higher adjusted pivotal support on the Aussie dollar, 66.05, maintain that bullish bias for the next intermediate resistance to come in at 66.60, followed by 66.90 over here, which is the swing high area of 17th of September and 18th of September. And if you do the Fibo extension from this ongoing impulsive upmove sequence, from the low of this 21st of November, project it up towards the high of 28th of November, push it down to the minus swing low of 2nd of October. That also, whoops, sorry, so I should take this high over here. That also confluence very closely to the one-time Fibo extension level, right, at 66.84. Only a bearish breakdown below 66.05 will negate this bullish bias direct view to see a deeper corrective pullback towards 65.80, which is the former minor swing high area of 13th of November, now turns into a pullback support. Failure to hold this level will see a deeper retracement towards 65.37, which is the minor congestion area here of 28th of November and 2nd of December, and so confluence very closely to the intersection of the 50-day and the 20-day moving average. And if you do the Fibo retracement of this ongoing impulsive up move sequence or structure from the low of 21st of November all the way up to Friday's US session high, which is at around 66.49, that also confluence with the 50% Fibo retracement. All right, so that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen continues to inch downwards below the 20-day moving average after almost a second retest of it on Friday US session. So with this second retest on Friday US session, and right now with the RSI breaking below a former minor ascending trendline support as we are speaking right now, we will maintain a bearish bias on the dollar yen. Since last week we have a bearish bias already, with a slightly lower adjusted short-term pivotal resistance at 155.50. So 155.50 will be my lowered adjusted short-term pivotal resistance level, which is confluence very closely with the 20-day moving average. Still maintain that bearish bias for a retest on last Friday swing low area at 154.40, which is our first support level. A breakdown below 154.40 will expose the next intermediate support level at 153.80, 153.60, which is the minor swing low area of 11th of November and 14th of November. Only a bullish breakout above 155.50 will negate the bearish bias tone on the dollar yen to see a squeeze up to retest 155.95, 156.18, which is the minor swing high of 2nd of December that got rejected exactly at the pullback resistance of the former key minor ascending trendline support taken from the low of 29th of October. So that's for the dollar yen, still maintaining that bearish bias, but with a slightly adjusted downwards short-term pivotal resistance at 155.50. All right, so that sum up all the 4 intraday technical outlook on the 4 major US dollar pair. Let us now proceed to the major stock indices, starting with the Asia Pacific region with the Hong Kong 33. So the Hong Kong 33 still continues to come break above the 20-day and the 50-day moving average. So it got rejected since 26th of November. All right, so on last Friday US session, it got rejected again. And right now it's attempting to retest the low of last week, which was at 25,660. So with this mixed technical configuration on the Hong Kong 33 that is representing the Hang Seng Index, we will still maintain a neutrality stance with a new neutrality range for today, given the latest price action. So lower neutrality range will be at 25,660. Upper neutrality range will be very closely to the 20-day, the 50-day moving average. I think as the key range resistance level, 26,275 slash 26,310, a bit of excess due to that previous bearish reaction of the 20-day and the 50-day moving average on the 17th of November. So ever since this bearish reaction that pushes it downwards, it can't break above this level ever since over here. So that could potentially be a sentiment level to watch out for the boost at the upper limit of 26,310. So neutral between 26,275 slash 310 upper limit, lower limit of the neutrality zone 25,660. Next up will be the Japan 225 that is representing the Nikkei 225. So in today's Asia session, there is an intraday sell-off at the start of the Japanese stock market trading hours at the start of it at 8 a.m. Singapore time, but managed to find support right exactly above our pivotal short-term pivotal support zone at 50,150, 49,960 that we defined on last Friday. That also confluence with the 20-day moving average. So no change, still expecting a recovery to take shape on the Japan 225, and also given the fact that the hourly RSI also managed to find a bounce of a parallel ascending trendline support. So using 50,150, pardon me, 49,960 short-term pivotal support level, maintain that bullish bias on the Japan 225 for a potential recovery after that consolidation that has taken shape since last Thursday. First resistance level to watch will be the start of the consolidation on last Thursday, which is the minor swing high of 50,985. A break above 50,985 will strengthen the bullish momentum to expose in first step the next intermediate resistance level at 51,530, which is the minor swing high of 5th of November, 11th of November, and 13th of November. Only a bearish breakdown below 49,960 will negate this bullish bias / recovery scenario to see a deeper pullback to retest the 50-day moving average, and so confluencing with the medium-term ascending channel support from the low of 7th of April 2025, confluencing at a similar level at 49,085. So that's for the Japan 225. Next up will be the Germany 30 representing the DAX. So the Germany 30 managed to hit our resistance level as expected for 24,140 before doing a minor pullback during the US session, all right, over here. So with that, potentially the RSI has now started to exit from the overbought level over here. There could be a minor pullback taking shape at the start of the European session today. First pullback support level to watch will be the lower limit of this ongoing minor ascending channel that is still in play since the low of 21st of November, now acting as a first intermediate support at 23,910. So I will actually tighten my pivotal support level towards this former minor swing high of 3rd of December. Over here, previously there was some struggle by the bulls before breaking up on Thursday, and we have a minor hourly bullish hammer candlestick low, retesting it at 23,800 level on the Thursday at 5 p.m. Singapore time. So with a slightly adjusted pivotal support level at 23,800 on the Germany 30 CFD index, we'll still maintain that bullish bias on it. First intermediate resistance level to watch will be last Friday US session high at 24,140. A breakout above it potentially take us up towards the next intermediate resistance level at 24,390. We also confluence with the upper limit of this minor ascending channel. One-time Fibo extension from this ongoing bullish impulsive up move sequence from the low of 21st of November, and as well as the former minor swing high area of 21st of October, 27th of October, previously has a bullish breakout on 12th of November, but the momentum can't maintain and did a reintegration back below 24,390. So this 24,390 has a clearly critical sentiment level to look out for. Only a bearish breakdown below 23,800 will invalidate today's bullish bias on the Germany 30 to see a minor corrective decline sequence unfolding again in first step towards 23,670, which confluence with the 20-day moving average. A breakdown below it potentially take us down lower to the key 200-day moving average at confluencing at the closely with the next intermediate support level at 23,480, which is the minor swing low of 26th of November and 1st of December, where it managed to survive that steep intraday sell-off previously from the high of 28th of November to 1st of December. All right, so that's for the Germany 30. Next up will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 continues to bounce and remains bullish constructively, as what we could see is that the hourly price action continues to bounce off the lower limit of the minor ascending channel that has been in place since 24th of November. RSI has now started to shape a higher low as we are speaking right now in the Asia session. So the bounce also took shape exactly at the start of the US session at our predefined first support level at 47,754. So given that it can't break above our intermediate resistance, we predefined it on last Friday before the start of the US session at 48,000. So if we have an hourly close above and a bullish breakout above 48,000, then I could be more confident to tighten my short-term pivotal support to 47,750. So for now, I'll still maintain that pivotal support that I have on last Friday, 47,560, still maintain that bullish bias. A breakout above it potentially see a test of the current all-time high area at 48,450, which is the 0.618 Fibo extension of this ongoing impulsive up move sequence from the low of 21st of November. And this is the current all-time high that has been printed on the 12th of November, previously at 48,450. Only a bearish breakdown below 47,560. Only a bearish breakdown below 47,560. Pardon me, earlier. We will invalidate today's direct bullish bias view to see a deeper minor corrective pullback to retest the 20-day moving average, which confluence with the minor swing low area of 26th of November and 2nd of December at 47,180 next. All right, so that's for the Wall Street 30 representing the Dow Jones Industrial Average. Next up will be the SPX 500. So as we are speaking right now during the Asia session, it's now attempting to break out above our predefined first resistance that we have on last Friday at 6,880 after almost shaping a bounce at the start of our US session at our predefined first support level at 6,840 during the Friday daily dose session we are sharing with you guys. So unless we have an hourly breakout and the hourly close, unless you have a bullish breakout and an hourly close above 6,880, then I would tighten my pivotal support to 6,840. So for now, the pivotal support still remains the same, slightly adjusted to 6,807 for today, which is the minor swing low area of 2nd of December and as well as 3rd of December. Next resistance level to watch after 6,880 will be the current all-time high area at 6,930, which confluence with the 0.382 Fibo extension as well from the minor low of 21st of November, which is the start of this new bullish impulsive up move sequence. Above 6,930 potentially take us up higher towards the psychological level of 7,000/7,005. We also confluence with the 0.618 Fibo extension from the low of 21st of November low, which is the start of this new bullish impulsive up move sequence. Okay, let me put it in writing. So this will be 7,000/7,005, right? Over here, after the current all-time high at 6,930 has been taken up. So that has been printed on the 30th of October. Only a bearish breakdown below 6,007 will negate today's direct bullish bias view to see a deeper minor corrective pullback towards the 20-day and the 50-day moving average, confluencing at the next intermediate support level at 6,780/6,760. So that's for the Nasdaq 100. Next up will be that's for the S&P 500, a bit of time to think. So next up will be the Nasdaq 100. So the Nasdaq 100 also remains bullishly constructive as it managed to now retesting that 25,760 current all-time, 25,760. That was the first intermediate resistance that we predefined on last Friday. So last Friday, it tested it again during the start of the US session before doing a very tight sideways range configuration throughout the US session. So still no change. The hourly RSI remains bullishly constructive and managed to shape a bullish reversal at last Friday US session at the 29 p.m. Singapore time. And in today's Asia session, right now, it managed to stage a higher low as we are speaking right now. Okay, over here, there's a higher low taking shape, right, indicating that short-term bullish momentum remains intact. So for now, the first support level to watch out for will be last Friday US session low, swing low area at 25,580. So unless we have a clear bullish breakout and the hourly close above 25,760, I will tighten my pivotal support level to 25,580. So for now, I still remains the same pivotal support level as of last Friday, 25,455. Next resistance level to watch after 25,760 will be 26,070, which is the 1.382 Fibo extension taken from the low of 21st of November, which is the start of the current bullish impulsive up move sequence. Above it, we'll see 1.618 coming in, Fibo extension, which confluence very closely to the current all-time high area at 26,290 that was printed on 30th of October. Only a bearish breakdown below 25,455 will invalidate today's direct bullish bias view to see a deeper minor corrective pullback to retest the 20-day and the 50-day moving average, confluencing closely with the next intermediate support zone at 25,305, 25,185. All right, so that sums up all the intraday technical outlook on the major stock indices. Let us now cover the commodities market, starting with Gold XAU/USD. So Gold going to trade in a sideways range configuration since last Wednesday. Yes, last Friday we do have a bullish bias, but I mentioned this bullish bias is more in the minor sideways range configuration that has taken shape on 1st of December. So last Friday, it managed to test our first resistance level at 4,267. So printed a high of 4,259, give or take. It's very close to 4,267. So still continues to be congested within this minor sideways range since 1st of December, means since the start of December month. So, but it still managed to hold above the 20-day moving average, acting as the same pivotal support in short term at 4,180. So given that it can't break above 4,267, the only meaningful pivotal support level will be the rising 20-day moving average, confluencing with the congestion area of 27th of November and 28th of November. So still maintain that bullish bias within this minor sideways range configuration in the first step, using 4,150 as my short-term pivotal support level. Only a bullish breakout above 4,267, then I will tighten my pivotal support to 4,190, which coincides with today's Friday minor swing low area as well. Friday low, US session low. All right, above 4,267, potentially see the next intermediate resistance coming in slightly below the current all-time high at 4,380. That is 4,340, which closed the one-time Fibo extension from the low of 28th of October and the minor congestion area here of 21st of October. Only a bearish breakdown below 4,150 will invalidate today's bullish bias view to see a choppy minor corrective pullback sequence taking shape again, testing the next intermediate support level at 4,105. Breakdown below it, seek out 4,038, which is the minor swing low area of 20th of November to 24th of November. So that's for gold XAU/USD. Lastly will be the West Texas crude oil over here. So very quickly, the West Texas crude oil right now is testing our short-term pivotal resistance zone at 60.10/60.40 over here. So with that, I will still maintain that bearish bias view, given that it can't have a proper bullish breakout above the 60.40 level on last Friday. So however, two key support level to watch on a downside bias basis will be this level here on last Friday Asia session low, which is at 59.47. Only a breakdown below 59.47, potentially seek out the next intermediate support levels, 58.94, followed by the 2nd of December minor swing low area that confluence with the 28th of November swing low area. 28th of November swing low area at 58.35 over here. So three key support level to watch out for today. So in order to reinstate that bearish bias view, you got to break down below 59.47. Let me put it in writing. 59.47. So that was Asia session low on last Friday, and also confluence with the 20-day moving average as well. All right, only a bullish breakout above 60.40 will invalidate today's bearish bias view to see a further squeeze up towards 61.30/61.70, which is the minor swing high area of 3rd of November, 12th of November, and so confluence with this medium-term descending trend line that has been in place since 31st of July 2025 high. So that's for West Texas oil. So before we go, let's have a quick look at the economic calendar. What are other key data to look out for this week over here? So let me refresh the data. Okay, let me push up. Okay, so this previous week, so let me put it up for this week. All right. Okay, so this week data to look out for at the start of the European session, there's nothing interesting over here. And also during the US session, there is also not much in key data to look out for as well. So today will be a rather quiet session in terms of economic data. And for those who have some interest on the Aussie dollar and the ASX 200, we do have some business confidence data out from Australia at 8:30 a.m. Singapore time. That is tomorrow before the start of daily dose on 9th of December, Tuesday. So that will be the NAB business confidence for the month of November. All right. So with that sum up today's daily dose of market insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.